Welcome, everyone. Hopefully there's some sound. Confirm there's sound. Somebody said the sound was not coming through. Anyway, welcome. We've got about, so let me know if there's sound. Everything shows here I should have sound. Got sound. Welcome, everyone. Yeah, I'm not sure why the video was not playing the sound. I actually do know why that happened. But anyway, we're here. Thought I'd come live. It's been a very interesting week. We've had quite a few things go on. I miss hanging out with you folks every day, so I thought I'd come up, do the last hour of trading, talk about several things that certainly have impacted the markets here right now. It's interesting watching things trade. We've got the S&P down a little bit here. The futures are down 10 handles right now, and we're seeing a little backing up, but a constant bid in the composite in the NASDAQ. It's very interesting from that standpoint. Of course, we've seen the yields just drop substantially. And if you go back to my last Sunday update, I discussed where I thought yields were going to come back into maybe 3.5, 3.4, even 3.2. And I put out a tweet a little bit ago. So those of you that got that tweet, maybe I can discuss that. We'll start off here as room's still filling up. But it's sort of interesting. Over on my left here, I have a 55-inch monitor, and I'll usually have Bloomberg on, and I'll turn the sound on and off during the day, mostly off. But I listen to some of these people, and this is no offense to anybody. Listen, I'm an old boomer. That's pretty obvious. But when I watch Bloomberg, I watch the coverage in the financial markets. It's pretty typical, even if you go to CNBC and watch what the talking heads are saying, as they're shocked. Somehow they still believe, and you folks have heard this from me, they still believe that the Fed is controlling rates. And I told you 6 months plus that the Fed wanted out of that business, and they are out of that business. And we'll talk a little bit. I'm going to go through a lot of Fed talk. So haven't had an opportunity to talk about a lot of macro stuff. So we'll focus on that. We'll get into some charts in a little bit. But I do want to cover these things because this is significant. As what I've been telling you is that the Fed is now going to be adjusting to market forces versus the other way around. In the past, everybody, if you've been around the markets for 20 years, you actually think it works that the Fed is affecting the markets to move forward. And they have been doing that. They've been manipulating them and holding them at near zero for forever. And I've talked to you also about the fact is that the typical interest rate that we have over the last 30 years is around where we are now, between 3.5, we'll say 3.5, that is the very low end, and somewhere around 6% in that range. And mortgage rates have run similar in between 4 and 7, and sometimes as high as 8 plus 8, 9. We had an 8 rate just recently, and we've seen rates come off pretty good. But this is the situation I believe we're in now. We are in a situation where the Fed is going to be responding to markets. It was interesting. There was a question in Powell's conference call the other day and said the market did your work for you by tightening, and now they're doing their work for you by loosening. And all that is, and this is what I said on my tweet a little bit ago, all that is that those are market forces by supply and demand. And that's what's causing these rates to move around. It's not, they're not doing anybody's work other than the market's work. And, if there's anything that's like the 70s or the 80s, is the market forces are running interest rates, not the Federal Reserve. And the Federal Reserve has always been adjusting their rates to where the market's going. And I'm convinced that's the market that we're in now. That's the way the Fed will handle things. And everybody's hanging on to every word. And, you're hearing the Fed pivoted on Wednesday. It's a big pivot, all of those things that are happening here. And I'm not sure that happened. All I'm sure that is happened is that markets are starting to see the flow and they're adjusting when rates came down. Obviously, a lot of bond buying, and we saw the interest rates drop. So that on the back end of the curve, the front end of the curve, they still have a handle on. They're still manipulating what's going on there. So they're going to keep those rates at 5.25, 5.25. The effective Fed funds, I've got some notes here, I think are running about 5.33 every day. Okay. So just know that the markets are going to drive where prices and where prices from the standpoint of bond prices, not the Fed. So point well made. So a couple other things that I think that is going to be interesting as well is the economic backdrop. I'll go there for a few minutes. We'll probably bounce back and forth between the macroeconomy and the Fed themselves. So on the macroeconomy, we continue to see these low employment numbers. And Powell said the market, that we've slowed substantially. Now, third quarter, we were talking that we were, 5.2 on the third quarter, but the year is expected to finish about 2.5%, which is, it's Goldilocks, right? Not too hot, not too cold, just right. There's no recession. I've been saying that for a while. I still don't see the recession that's out there that people are still talking about, and they're so hung up on this slowdown that they're kind of stuck there. So I've told you multiple times on the channel that if you want to be a really good analyst, just fade what these people are saying. So a couple things. Last year, if we spend the clock back a year ago, what did we hear? After 22, it was terrible. It's even going to be worse in 23. Meanwhile, I think NASDAQ's pushing 50% up. S&P up over 20% as we speak, coming into the year-end on highs. And now what are those same people saying? Now they're optimistic coming into 24, and we see more positive. Okay, so what does that tell you? Maybe a little cautious coming in. And I'll try to tie things together the best I can in the next hour, and because I've just got a lot on my mind, and I needed to get this out of here and into you folks. So I'm just looking at some of my notes here real quick. So let's talk about, I think, the likelihood of things. We are sitting here with the premiums and the futures. I think we printed 2 handles from ATH the other day. The number you're probably going to want to watch on the markets right now in the S&P is the cash markets, and I think it's 4808. I believe, I'm going off my memory. We'll look at charts here in a minute, but that is where I believe that's where the ATH lies, and maybe we get up there and we fade off, but overall, this is what was becoming very obvious through a number of things. And I'm going to tie together our database, turned very bullish going back into mid-November. It started to become obvious that we were forward-looking. We're going to see higher prices, all those things. I saw somebody on Twitter criticize me. Well, I was a couple of weeks earlier, I was saying we weren't going to see all-time new high. Well, markets are dynamic. When the numbers change, you should be able to change with them and change your forecast. And if you can't do that, then you're not going to even have a chance of being successful, because nobody, look at the folks, I always joke about Peter Schiff and Harry Dent and all these perma bears. They're just dug in on their ideas. You don't want to be that trader. That's not who you want to be. So I'm just looking at some other notes here and making sure I'm getting some of these things, preliminary things I wanted to talk about. So let's go back to the Fed. Let's talk about Powell. Did he really say they're talking about lowering interest rates? I think he mentioned it was in a conversation, but the markets hear that, and with the algorithms and with all the power of the computers out in the world, they're able to make a lot of things happen. And I used to joke, is it Memorex or is it real? There was an old commercial that used to be out for Memorex. It's so good that it feels real. That's sort of what we're dealing with, is that the market sentiment has switched quite a bit from where it was. And that's why we've seen this unbelievable rally as we come into November and December and the year end. And that's a seasonal tendency anyway. So the real question is going to be, and I'll try to handle this this year. By the way, I'm going to be hanging around. I'm not going out of town for Christmas. I usually do. This year I'm going to be around. So I'll try to do something the final week of the year. I'll be hanging around doing things like this, probably impromptu for the moment. We are working on a number of things on the channel that we believe are going to enhance delivery of information substantially as we go down the road. But you have to realize something, folks, is that these folks that are telling you it's optimistic were the same people said it was pessimistic last year, and they completely missed this year. You know how many we have engagement with the advisory community. You know how many advisors and people have underplayed this market and not achieved anything that they should have done? These are the years when you have a 50% gain or a 20% gain in the S&P, and these are the years you can't afford to miss because you never know when the next one's going to come. And even probably the guys that did okay were the 60-40 guys. And we have in our software, I could show you, or we have the 60-40, but I think you should rebalance once a year, not multiple times during the year, because you dilute the performance. You actually want 60-40 to get imbalanced to do well. So this year, the imbalance went to the equities, and now with the little bond rally that's come in year end, it's kicking it up pretty good. I haven't looked at numbers, but we're looking at 60-40 being up over 15%. So those folks that stuck, and they have a term called stayed the course, actually did okay this year if they didn't rebalance. If you rebalance through the year, you took away and you cut that performance in half. But so this has been a very unique year. So I would suspect with what we're seeing in the rhetoric around the markets, all of the talk that's going on, that they've got it wrong again. Okay, it's probably not going to be as optimistic as everybody's saying it's going to be. And it's not good. So there's two parties. You got the folks that used to be the bears are now becoming the bulls, and then you got some of the bears dug in, and they're still talking about recessions and all those things. My view on this is that there's probably not going to be a recession. I'm going to stay somewhat neutral. I think it's kind of hard to come up with a recession when you're printing 5.2 quarters on GDP. And I know there's an argument out there that all the numbers are phony, and there's a lot of numbers that are fudged in there and estimated and those type of things. But in the end, the markets look at these numbers to make decisions, and the markets being the market participants. And so when you're locked into looking at these numbers, it's kind of hard to argue when the algos and the cash flow is being generated appropriately. So I'm kind of on a rant all over the board a little bit, but kind of walking down this thread of what's likely as we come into year end. Maybe we end up printing all-time new high on the S&P. Maybe that's in January. It does look like, as I'll show you in some of the technicals here in a few minutes, I do believe it's likely to happen, and it doesn't have to print here. If it doesn't happen by year end doesn't mean anything, but there appears to be a flow of the markets, and the algos and everything that I do are continuing to demonstrate that there's higher prices. And that's, as you could go back and probably watch November live streams that I did, and you'll see I was talking about the projection at least into the first 2 weeks of December that we're going to see strength. That's kind of extended a little bit more, and it's also extended by our database getting into some of the places it has. So let's see here. We've got 173 live here, so that's good. Look at a couple comments here real quick. Yeah, I think, listen, I'm trying to bring in some perspective. Somebody made a comment on Twitter the other day, and I really appreciate it. I'm a pretty straight shooter, but everything that I do by straight shooting is through the database and through a lot of decades of doing what I do from the standpoint of seeing the flow of the markets. And I've always told you folks, I am unique because I built a database of over 15,000 symbols in it, that the same type of algos, trading algos, are being on every one of those symbols. And we've optimized, we have two basic models that we've used over decades. And those models tell me where the cash flow is. And it's not about, I keep telling you folks, it's not about being, there's X amount of stocks over the 200-day moving average. Who cares? That's just a number. But what you want to know is how many stocks are actually trending. And that's what our database tells you. These are stocks that have been noticed in the database that have probabilities of appreciation. So right now we're pushing 73%. So 7 out of 10 symbols in our database, mutual funds, ETFs, individual stocks, and even bond funds. All of those, out of all of that, 7 out of 10 of those are suggesting that prices are going to go higher. And this has been the case going back when we got over 42% several months ago. This was the pivot point from the market's standpoint, and what we were setting up as we were coming into year end. So I'm just looking at my notes. I had a lot on my mind, so I wanted to get this stuff out there. Just looking at, yeah, I think I've covered just about everything. Yeah, so a couple things before we go forward here. Those of you that came to the seminar, there's a couple things happening. We're working on a book that is based on what went on at the seminar. It's coming along pretty good. Everything's taking us longer. Always, like everything in life, is taking us longer than what we thought. There's also, we've got, as of this moment, I believe if you go to kindlereport.com/indicators, I believe it's over 50% discount for year-end discount. So if you've been wanting those indicators, get those. We're also going to be announce our mastermind class, which is the interaction with those of you that came to the seminar. And we may do a special event where everybody's invited. Maybe we do a live event with the only people asking questions. Maybe we'll put a Zoom meeting on and simulcast it on YouTube or something like that. But we'll be focusing on the questions and information that comes from the Zoom. And then we do have this market mastermind also coming out. The final videos are being edited, and there's so a lot has been going on behind the scenes. And as I've told you, just to interrupt before we go on to final analysis here, is basically we're pivoting the channel a little bit from the day-to-day stuff. I really don't want to be in that space anymore. It's fun to do, but the content that I've been putting out is good for basically one day, maybe a couple days, and that's great for traders and all that. But what I want to do is really put out content that's going to have a little more longevity, a little bigger picture, looking out more macro, some educational, all that stuff. So that's why we're doing all the things we're doing. And part of this is really to help. Somebody made a comment, I think on a DM on Twitter or something. Somebody that follows me and I follow them back made a comment that, hey, Bob, teach us how to fish. So that's going to become my mission. I've got some other situations going on that I am going to be doing potentially a whole separate channel just for education, and more education for people that want to manage their own money, and including our advisory and institutional community. We're working on a platform for that right now. So a lot of things going on, and I appreciate everybody showing up and doing this stuff. So let's take a quick look. I'm going to bring up the WaveTech database. We'll go through some charts. I'll probably come back and forth on screen. I think I have another screen that I can come up on and show you content at the same time. But I'm just looking here at the markets right now. Not really much change. We're down 10 handles yet on the S&P. Composite is bouncing around between up 20 and up about 40. We're looking on the NASDAQ futures up 61, up 0.36. So there was some imbalance overnight that created that. One last comment before we go forward here. I just happened to look at them. If you go back to a couple things that happened last year. At the beginning of the year, I was very optimistic. We started to print over 42%, and we got a lot of positive flow last year. Like I said, we got NASDAQ up big numbers, all that. One of the other things, when the so-called banking crisis, there were a couple banks that were in trouble, thanks to interaction with Dr. Jim Baker and myself, and those are pretty critical times with Jim having being an ex-banker and being able to bring in some serious perspective, but coming in and realizing all the Fed had to do was open up a discount window. They put a new platform together so that they could support the banking system, and the so-called banking crisis went away really quick. And it was really just a couple banks, and the only reason why we saw any bank stress at all is because this was not, the liquidity factor was not focused on this. This should have never happened, but it did. I told you it was nothing. If you look at KRE, QABA, and KBE, you look at the banks, they're down today pretty good, but they've had a serious run. That we've seen a big boost up, and I just want to comment on this before we go in to look at some charts, is we also saw the Russell explode. That was something else I talked about last Sunday. Had a huge week. Russell's down about 1%, but I mean, it was up big numbers, I think 5.5+%. And so all of these things, and I told you on Sunday, if the markets are going to do better as we come into year end, then we do need to see the small caps. We do need to see financials and some of those things come into play. But I'll go through and we'll look at some charts. Before I get in too deep, I'll take a look at some of your comments you guys have, so maybe I can interact with some of that stuff. So I know I just went on, what did I go on? A 25-minute rant on stuff, but I think these are things to try to put into perspective as we come into year end, and then especially starting to look out. Like I said, I'll probably do something else before year end to really set up to see what we come into maybe the last week of the year, something like that. I have a potential trip I'm going to make sometime in late December. We'll see what comes up, but I want to come up one more time, just kind of set up as we come into 2024 and what to look for. And anytime you get a year like we've had this year that everybody had wrong, you have to be careful. It's funny. Think, just one quick comment. Think about what happened. 22 is absolutely horrendous year. Markets down. Everybody came in the year expecting more down. So they're all talking about what's already happened. Now here we are with this huge rally, and what are they doing? They're talking about what already happened and trying to extrapolate that out in the future. I always call it the Jim Cramer trade. Buy high, sell higher. And sometimes it works, but a lot of times it doesn't. That's why Cramer has a reputation that he does. So if you're down and you're selling, and that sentiment, you get into that, you really have to realize that a lot of these markets, and I'll probably be talking about emerging markets, some other things that I've been looking at that might be a play. The play coming into 24 will be different than what we saw this year. Probably not going to be all tech. I saw some analysts, portfolio managers, somebody on this morning. They're still focused on tech, and I'm, like I said, looking here, we're up 0.4 on the NASDAQ as we speak. So there is a bid in the tech, but they speak their book. They also, that sentiment kind of flows through. So, all right, I think I'm done. Let's go ahead. I'm going to go to the WaveTech database. Let's talk about that, because I think there's some expectations to be built from that. And then from there, we'll go into a couple charts. I'm not sure how deep, and then I'll look at some of your comments and interact with some of you folks. So hang on. Okay, folks, we're going to have to deal with these small numbers. I realize I did not set up the scene for that was blowing up, so I'll just tell you what these numbers are. Right now, the daily database is 79.70. We're starting to see a little rotation here. We're pretty peaked out. I talked about this on Sunday night, so it's played out. Right now, the average duration is 17 days. We're about halfway through this cycle. So certainly as we come into year end, the first week of January, it looks like forward looking that the forward looking from the standpoint of what is likely to happen in the rotation here. So let's take a look here. Let's go over to the weekly just to get some perspective there. So the perspective I'm looking at, 73.39%. Today's Friday. We run our weekly models today. And what's likely to come out of this stuff is more, a little more buying. We could see 80 percentile plus. It's going to be really difficult, in my opinion, to get beyond this forward-looking scenario of after this week and last week. You're just seeing a lot of stocks still rotate in, but I do think it's getting a little frothy up here at 73 to 80%. Things are getting a little top heavy, but what that means is we get a rotation, some consolidation, and then probably it's possible that as we come into February, I'll try to extrapolate this out. Like I said, I'm hoping that we'll have another opportunity as we come into year end to update the expectations here, and especially in the early in the year. So my plan is to do more macro events like this without getting into too much. And even when I go to charts here in a minute, I'm not going to go to the hourly or the short-term stuff. We're going to stick with kind of intermediate. As far as Sunday night goes, it's possible I will be back on Sunday night. There is some variability in what I'm doing. So make sure if you haven't subscribed, hit the notification bell so you'll know when I come live next. That's going to be more important than it has been in the past, by the way. So let's take a look. I know these are pretty small on the screen, so let's kind of go over and let's take a look at the S&P. All right, so this is interesting, I think. Look at the algos. I was looking at this, it's a spaghetti bowl. I think if I'm just going to blow this up a little bit so you can see it. You got some things starting to roll over. It's just one of these situations where what's likely to happen is that we're going to go sideways into these moving averages and right into year end, what it looks like that around 47.78. Now this is the nearest futures contract. So it has that premium. I think it was like 45 handle premium. So there's no way to get around this if you're going to do continuous charts and I've used these for years. I hate rollovers. Everybody does. But the rollover, like I said, we're very close to an all-time new high on the futures because of that premium that's there. I think we watched the S&P cash for the real ATH, which will be 48.08. I'll bring it up here in a second. But look at the algos. They're all suggesting that as we come into year end, we're likely to see them flattening out. I saw, I did see a comment on Twitter like, hey, I can't make it from work, but please, cover this. So a couple things. When you see these PPMs turn down, it does not necessarily mean markets are going down. What's happening is oftentimes they're just bleeding off some of the momentum on the upside. And somebody was also get an email question about divergences and things like that. The beauty of the PPMs, divergences aren't they can be important, but I don't really focus on them. I really focus on just the angle of attack, which is what we're seeing here is still pretty steep as we come into year end. Now, this is a daily chart. So let's flip over to the weekly and see what kind of, you can see that we're printing through right now the RTX level. And let me just see something. Let's bring up so RTX is 4740. So we're through that quite a bit. We're looking at right now the last print here at 91, I believe 99. This is weekly. Let me go back here. Let's come over here, just see what that high was. Okay, here's 4808. So the weekly futures high was 4808. So that's where we have to print. That number that got stuck, I thought it was a cash number. That is actually the futures number in January of 2022. So we are getting a same kind of spaghetti bowl, if you will, on the algos. They're all predicting rolling over and actually coming back in right now that the moving averages are going to be in a 44, 43 handle. And that's certainly a possibility, especially since everybody and their brother thinks we're bullish coming into the beginning of the year. So, but you can see these algos, how they're set up. I'm going to go over to a monthly chart quickly. And this is where we're still seeing this positive angle of attack. And I've talked about this as well. This carries this is monthly. So it carries this all the way pretty much through the year into around the election time. And this angle of attack here is very steep. And what I suspect we'll see happening, not this month, but as we come into January, potentially seeing the market grid turn down, and we set up a consolidation here. And it's interesting because I was looking at this, trying to put the puzzle together, and I'm looking at PPM3 down here below, which is tracking the 40-period moving average, telling us that momentum is going to flatten out substantially. So that would suggest that all of a sudden the probabilities of coming back into a 45, 43 handle would be likely, but still be within the context of higher prices and down the road, all the way, like I said, into the election, and stable to higher, just not some runaway. If you look at what's happened, look at the print. We had a 4122 print just in October. It was almost, if we went back to last year, October, that was also the low bar in October. So what we're seeing here now is we got another October low, and the question is, and this is what I'm just proposing this out with you folks. I'm going to bring up a drawing tool real quick because I was looking at this earlier. So we have to ask is what's happening here? Is this, I'm potentially thinking we get a pattern where we're seeing this type of configuration where maybe this was an A wave, we got a B wave high, and then a C wave down here into the moving averages, and then maybe higher prices. And it's very interesting. I'm going to take all this stuff off just to show you. If we go in, I believe let me put something up here real quick. Sorry. Yeah, I was looking, oh, there we go. I just didn't have the scale right. Apologize. So these numbers, I've talked to you a lot about. I'm going to get these Fibonacci. Haven't mentioned these numbers for a while, but you can see it on videos. We go back all the way to March of 23, getting projections for literally for a 6,000 print on the S&P. And there's an argument that this ABC then projects us up into this pattern. The thing that is not being revealed yet is whether we're going to see the PPMs actually turn into that type of situation where the PPMs are actually, as we come into October 24, are suggesting the opposite, that we are going to hit a peak. Maybe we make the lower number, 6,000, certainly possible, because you think about it, is that really a big deal from here if we're basically almost 5,000? Is it going to be that big a deal to print 6080? I think the number is. Let me look at that. 6136 is that first Fibonacci number. So that's the big dilemma. Is this just a continuation? And I am working on a video at the moment. Yeah, so I'm working on a video at the moment. This is not the view I was hoping to get, but this is one we got. I'm working on a video at the moment that's talking what I believe is likely to happen as we go years down the road with the some of you are going to roll your eyes when I say this, but basically what I'm looking at here, I'm just going to come back full screen. What I'm looking at here is what's AI is likely to do to the economy and GDP. And I've got a video I'm working on right now that's talking about the major multiplier in producing GDP. And I'll give you a little teaser on this, is productivity. And productivity multiplies everything as far as the output goes. And so ultimately, I guess I will tell you that this is the sneak peek, is what I believe is everybody's got it wrong talking about the debt, because if you can multiply productivity that multiplies GDP, the ratios to GDP change. No one's talking about hyper growth that is likely out of the AI. Everybody's talking about we can't pay our bills and all that scenario. So you already know that's the wrong one. And I will show you in this video when I produce it. I'm actually got most of the script ready to go, that this is the wrong hypothesis. Okay, back to the charts. Yeah, Todd, I see your comment here that it's only 25% away. Seriously, these are very small numbers. When I finish this video that I'm working on, you'll see exactly what some of the assumptions that are being made and looking forward. All right, since we're having so much fun with the monthly chart, we'll just start there. Talk about crazy projections. Look at these numbers here for 20,000 on the composite. One of my favorite jokes to go back to, folks, was back in after the .com bust, that the NASDAQ would never see 5,000 again. So we've only tripled it since then plus. But this is these are the same projections that are showing up, but the same scenarios unfolding here on the potential momentum. Everything seems to be spiking out or peaking out in momentum. It doesn't mean the market's going to roll over there, but we're looking like we're coming into maybe into November before we see some of these numbers really start to peak out. So good news is I'll be around talking about these things as we go forward. Yeah, hopefully, probably the sound was low. It should be okay now. Yeah, and productivity numbers are already rising, but you've seen nothing yet, is what I'm about to tell you. All right, so let's go to a weekly view real quick. These are pretty static, same scenario, same formation, same everything that's on the S&P. The only one that's worth really looking at is if the scenario on the Russell is correct, then that's where you're likely to see a lot of this productivity. It's also, I'll do a very quick interest rate forecast. We'll talk about interest rates before we go. Maybe we'll touch on maybe Bitcoin at the end. We'll see where we get. But I think this is very interesting here from the standpoint of everything is sloping up. Now the Nasdaq starts to flatten out. It doesn't have quite the crazy spaghetti bowl I was talking about, where all the projections of the moving averages going forward, that they're as crossing over and really giving an interesting mixed picture. But the PPMs are all the same on all these indexes. It looks like these are peak momentum moments, but the fact that they're peak momentum doesn't mean that it's the end of the trend. Trends will elongate a lot. They can actually refresh. What we'll watch for on this stuff is that the WaveTech database is going to be the real leading indicator in how we rotate that database over the next 3 to 4 months. I'll be able to nail this thing in pretty quick. And if you've been watching the channel for long enough, you haven't figured out how significant the database is and making these projections, then you haven't really been watching, because these are the primary data that's going to guide me and walking forward what's going on. And that's what came out last year. We went through a rotation this year where we got into a 60+% handle and then pulled back into, I think, 41 and change. It came right to the magic 42 number. And then here we are up at 73 again. So there's a rotations going on. And this can continue to happen. I've seen multiple years in the past where this has occurred. I don't know what it's going to be. We just have to read the tea leaves as they're presented to us. But at the moment, it does look like everything's going to flow on these indexes, at least into first quarter. So we'll still see some rising prices. So it's the point where a lot of folks that are out there will probably feel like they're right anyway. I guess you've got to set them up pretty good. I think even if you go back to early January last year, they made them feel good before they slaughtered them all. So let's take a look. Let's go to the Russell. All right, so I'm going to the cash. I'm going to the Russell 2000. And this was a scenario that I've been talking about for a while, and we've already went above the first fib target that was talked about. I'm going to go back to November 20th here, and the projections on the upside were for, I'm just getting the numbers, let me get them set up, 1932, 2046, 2117. So we printed almost up to, we got to, I wish TradingView had like a floating data window so I didn't have to do this. We got up to 2009. They were a little short of that 21 handle, or 2046, and then the extreme handle would be up here. And even though this is a significant rally, I want you to notice this is a weekly chart. This is the same scenario that we've been in for going all the way back to April 22. We've just seen this massive consolidation. So let's try to look out a little further and try to see if we can put some kind of scenario around here. And I think it's becoming very obvious, is what it looks to me as we're going to break out of this upward handle around 2100 and start. That's when we're going to know if the small caps are going to start to lead. And in those small caps, you folks know this, there's a couple things to consider. And I'm going to, as always, the interest rate forecast and what's going on here matters a lot. And what that tells us is that the potential for interest rates staying down low 4 handle, maybe as low 3 handle, which I'll discuss in a minute, will be enough to maybe wake up some of the zombie companies, if nothing else, at least give market participants a reason to look at these small cap stocks, because they've been just hammered down in the zombies. I've called them zombies in the past, and that's very true from that standpoint. But I do expect that we're going to see a continued appreciation. Everything flows into the same number, November 24, election time, all that. Well, it's going to be a really interesting year, I think, especially on politics front and geopolitical. There's a lot going on. But the interesting part from here is I want you to notice that for at least PPM 1 and 2, they don't have the negative runoff that the S&P and the NASDAQ has, meaning that the PPMs are not forecasting lower momentum. They're all PPM 1 and 2 are forecasting higher momentum, and PPM 3 is basically stable. And because this is a monthly chart, it's going to take a lot to turn this up. But the bottom line is everything else is pretty much the opposite of what's going on in the S&P and NASDAQ. So that suggests to me there will be a cash flow change to the smaller cap stocks. Now, you're going to have to be really good at picking stocks. That's a whole nother scenario. I could do a whole video on that, because we actually, in our WaveTech offering, we have monthly screens that you can get from, and we screen for certain characteristics. And that's something, as we come in the first of the year, I'm going to be also on the educational side teaching you how to manage your own money and using some of these tools that we have that are very good management tools. But this scenario that's flowing here suggests there's going to be a change in the flow of the markets, and it's likely to be substantial and elongated, meaning it's going to last longer than people think. So hopefully what we hear out there, once again, putting our reverse fundamental hat, is that nobody believes this is where money's going to go, so therefore it will. And if everybody's still hung up on the tech stocks and all that, then that's a good sign if that's the rhetoric we're hearing out from the marketplace. And I'm telling you, I'd probably watch, throughout a whole day, maybe I get 20 minutes of watching Bloomberg. And it's just like, I wanted to do a video the other day highlighting some of the clowns, which are the people, the talking heads on some of the closing shows, and even the early morning stuff is really, really funny to watch, actually. And Bloomberg does something every day where they have their question of the day. And it's usually probably the stupidest question you could ask. But the issue that I'm talking about here is something where we're likely to see a rotation in cash flow. And that, for me, is going to be the thing that is going to guide us. If we're going to see 6,000 S&P, 20,000 NASDAQ, it's actually going to be happening because of the cash flow, which is going to help sentiment across the board, I believe. This is why most of the times in my 40 years of being around the markets, this has always been the case. That doesn't mean it has to continue. There may be a shift in how things start to flow, but I think this is a real thing. And if the algos and you get the investment community, which has grown so large that is likely to go. I just got early imbalance sell side 1.1 billion on the close here. So just bring that into perspective. We'll see how that plays out. But this small cap is going to be very significant in helping us to kind of walk forward the sentiment and what's likely to go on. So I believe what we're going to do here is I'm going to talk about interest rates, come back. I'll look at the timeline. So if you have anything, a question or something, you can put that up there. I'll try to entertain a couple, and then we'll just call it quits. We're getting right about 9 minutes. We'll probably go in and watch the close and see what kind of flow we get here in the next 15 minutes or so. So we'll focus in on markets, do a couple questions, and we'll call it for the weekend. But once again, look at, and I talked about this on last Sunday night's video, as we're seeing a lot. This is a monthly chart. Monthly charts for interest rates are suggesting that we're going to come down somewhere. I taught you about this. I'm going to draw it in. I know I haven't been on here every day, but maybe it's better. You'll remember more of what I've been trying to tell you for a while. But let's take a look here. Let me get rid of some of these old arrows here. There's an argument for basically a five-way pattern here. We probably get something ABC pattern. We end up coming into this 40. This is a month, 40-month moving average. If we do that, that's putting us. I'll take a look at where this number is. I think it's around 3.2 or so. I have to take this indicator off to see this, but the bottom line is, look at the PPMs in the forecast. Lower that this momentum is going to burn off. Now, there is a substantial amount of momentum here. And we look at this. We get into, by March, it's interesting that the forecast for Fed funds, that the Fed is going to lower rates in March. But looking into March, it looks like an acceleration after March on PPM2, PPM1, the same way PPM3. Everything is accelerating. And so the range of expectations is right around, potentially, we'll call it 3%, could print a 290. And we start to fall into this band here between 3.8. We get into 3.8. We're likely to settle in at 3.5, 370, something like that. We should come into this little triangle formation here. And then it looks like everything starts to congregate, everything meaning the moving averages around 315, 3.5, around that range is where things are likely to go off. Now, this is a monthly, so it's going to take 6-8 months. You can see, once again, where are these things happening? Peak downside bond prices, lowest yields coming into September. So maybe there's more politics going on in the world in the Federal Reserve than you might expect, but I believe market forces will drive these markets down to this level. And as we go forward in the months to come, folks, what I will plan on doing is trying to tie in the expectations, because last year I told you that if you want to make a lot of money, I did an ETF hack on the, I think it's the home builders. I'm not remembering the symbol at the moment, but that strategy put into our software is up over 60% this year. That's all you had to do. And if you wanted to own a house, you should have bought a new house, because the builders gave all kinds of incentives, buy downs on mortgages, all types of incentives to get people to buy houses to get rid of the inventory they're holding on to. I still think that game may still be possible, but with rates dropping, the things are going on. So I could probably go for a couple hours, because there's a whole scenario around real estate that's setting up and other things that are happening. But just looking at interest rates, if we start to back this up, come into the weekly, we're down. It seems strange, but we're down to those fib targets, and the fib targets were 3.83, 3.641. So we're looking at the lows so far this week down to 3.88, and so that was into the fib targets. There's one more at 3.6 that plays into the scenario off the monthly chart I just talked about. I would probably start to bottom around that level as well. Yeah, I wish I had a couple hours. Maybe you folks have more time than I, but I've got some things to move forward to. But we could cover the Dow, a whole lot of stuff. I could go into a really deep dive. I miss the days when I used to do the 3-hour streams, and those were always fun to do, actually. But this whole scenario is setting up, and you can see it in Russell. You see the Russell projecting angle of attacks to the upside, where the S&P and the NASDAQ are still have upside momentum, but they're dissipating, where it looks like the leadership is going to end up over here with the Russell, and we'll know all about that at what number I told you, 2100 on the RUT. So that's going to be the place that you want to watch, and that's if we can start to get sustainability above that price, then all of this stuff starts to play out, because you're looking at here's that 2.8 number where it's being forecast. All these moving averages are 3.8 to 3%. This is where if we go out probably 50 bars in the future, the better part of a year, that's where prices start to end up. My expectation is that we probably bottom 3.7, 3.5. I'm not sure we get down to those low numbers, and if we do, it probably doesn't last for long. So let's do this. I know folks are always disappointed when I don't cover other markets, but we're right here at 1 hour. So I'm just going to come back up live here, and we'll look at some questions and see what's going on there. So let's do that. Okay, folks, I'm just adjusting. I've got a new setup here in the office where I can switch and I can see some of your comments without having to look off the screen here. Let me get it set up here. Yeah, I see Raphael's going, hey, we need you back every night. I get it. I miss doing it. I have told everybody that I personally trade better when I'm doing daily commentary of some sort. It really forces you to put yourself out there and say things out loud that most people aren't willing to say. Just looking here on some of these other comments here. 1 second. Bear with me 1 second. Let me scroll up just a little bit. All right. Somebody, Stephanie says, I just watched Harry Dent new video of his May 2009, same video advising to short stocks. He's advised people every year to short stocks since 2009. That is correct. He has done that. Meanwhile, he's still selling newsletters, I guess. I mean, he exists. It's like our friend Peter, same kind of situation. And you've seen there's a lot of folks out on the internet. That are I don't know if they're disingenuous or they're I guess as long as people keep buying their stuff, they're going to keep doing that. Ricky says, I miss you guys too. From that standpoint, I'm just looking at a couple of things here. Yeah, so I guess I just needed to rant today. So I'm glad everybody, folks showed up. We have quite a few. I'm sure we'll get several thousand views of this video, which is good. So just once again, I have to, what perpetuates everything we do is actually bringing value to our community. So just know, go to kindlereport.com/indicators, and you'll see the massive price reduction on the indicators. Soon is the mastermind course coming, and if you buy the indicators, you'll get a discount on mastermind and all of that. So we're just kind of going from there. All right, let me look at a couple things here. I need to use my mouse here. Okay. So if anybody, let's see here. Yeah, one of the things that that the plan. Let's talk about 2024. Hanging around Bob Kendall, using my tools, my information, everything. I'm going to be much more proactive from the standpoint of the other products, Portfolio Expert, Wave Tech. Like I said, portfolio management is going to become big on the list. And I think as we go forward, it's fun to speculate, and that's what the daily videos are about, trading indexes and doing all the speculation. What I want to bring to this channel is a bigger perspective of managing money and some of those aspects. And I've got some folks that I'm going to be collaborating with that is going to bring a lot of value into the community. So that's going to help our institutional folks as well as you folks that want to manage the money. I would tell you this, I'm very grateful for having this community. I mean, just, I always picture there's 220 people live right now. I would be honored if 220 of you showed up in a room. So I always picture a conference room with 200 people. I've had conferences where we have 300 plus. I know what the room looks like. Difference is you didn't have to get on an airplane and take time out of your life to show up today. So I appreciate it as if you did. And I think like I said, my goals, and I know a lot of things have changed around the channel. I used to produce videos, do the 15-minute videos. Then I went to live streaming. Now I'm back to no streaming on occasion. But we are still going to, the plan is to incrementally add in and put a schedule together where maybe there's a live stream sometimes during the month. Don't know how many. We're still kind of crafting something that's going on. I've got a lot of things going on in the background in my life that I have to attend to as well. So I'm trying to organize everything that I can to be able to participate that. Yeah, Keith is asking if I'm going to be doing individual stocks to videos. That would be, I think, interesting. We developed some. It's a really good question, because we developed some wave tech indexes. My goal was to develop indexes that represented the strongest part from the standpoint of our modeling capabilities with stocks, getting the best stocks to float to the top, not index based, not any capitalization, just does our software and our algos trade these well. And we have a way of doing data mining. Anybody that's used Portfolio Expert knows there's some pretty strong data mining capabilities once you get in there. So we have a way to kind of do this. We did build some indexes. I think we've got a Wave Tech 250. We did a bunch of stuff. We really haven't published much of that. That's happening at some stage. The other thing is we plan on having some other really, I'm not calling them very easy to access platforms on an app to be able to get to some of the data that I use, and also having triggers on the data telling you what the outlooks are and lag time. So I'm going to take a lot of these stats that I talked to you about and actually put them into a format that will make it usable. Somebody made a comment a little bit ago that the database is money, and it really is if you pay attention and learn how to read it. And so what we're going to do is actually put a product that actually does a forward projections and gives you some kind of, how far the meters run and all that kind of stuff. Yeah, Harry, you're welcome. Yeah, Raphael, I'll have to agree with you on that. Hang on. I have an iPad right here, and I'm streaming this stuff on my iPad so I can see it. But yeah, that would be nice. Hit the like button, right? If you're watching, go ahead and hit the like button. It doesn't hurt. It's pretty much painless. Yeah, just looking here at some of your comments. I think, yeah, so I'd see a question a little bit ago, and I think I answered, but I'll answer it again here. Will IWM outperform QQQ? I believe it will. Uh, it's more likely to outperform SPY. QQQ still, as I showed you some of these crazy Fibonacci numbers, there's still, if you look at the ratio of what being projected on the Russell versus the other NASDAQ or even the S&P, we start talking about 25% gain on the S&P to get to those numbers. I want to say it's about the same amount. So maybe it still lags a little bit, but there's a lot of money if cash flow starts to come in, and more money is made. Not so much. IWM is the easy way to go. So IWM would be, okay, I can buy the whole block, the whole basket, but you're going to be much better off if you can hone down some of these stocks. Instead of getting 20% returns, you could get 100% returns. And this is what I was talking about with the, doing the home builders last year. A bunch of these home builders, if you played a couple, were up 110, 120% plus. And it was right when everybody's telling you there's think about it again, folks. I keep telling you the easiest way, if you just pay attention to what's going on out there. And you had everybody telling you how many videos. I talked about this, I recall, coming into end of 22, how many videos were on YouTube on the coming real estate crash. There's still people out there. I saw one of the guys that I know was like super, super negative. Now he's like neutral. It's going to be flat. There's no crash all of a sudden. And this is what I'm telling you is you can get an amazing feel, and not just to be a contrarian, but this is how I use the database. I see all this stuff. Now we're looking at, think about this. Everybody's now bullish. Nobody believed me at the beginning of the year to be bullish and to garner 50% on the NASDAQ and 20% plus on the S&P. Heck, you could have, S&P was only up 8% like 6 weeks ago. So there was a 12% run just there. But my point is that, whoa, that startled me. Sorry about that. That was the bell. And I said we were going to watch this. Let's see how it ended up. Pretty much they recovered most of the losses. But the bottom line is, yeah, wow, that startled me enough. I wasn't paying attention. Anyway, yeah, so I kind of flashed me out of the script here for the moment, but let's just kind of wind it down. Appreciate everybody hanging out today. Great comments. If you don't follow, one of the things I do want to do, so if you're hanging out, there's 200 of you, you should go subscribe or at least follow me on Twitter, X. And right now I think I'm at 8,700. If I get over 10,000, so tell your friends, if you're already on Twitter, I know a lot of people don't do Twitter, but if I can get over 10,000, I can live stream on Twitter then. And there's some things that I want to do I don't want to do on YouTube. So I just need to promote the X handle as well, so I can get to the point where I can start to do some live streams on there. I think it'll be really interesting. I've got some things that not controversial. I just don't want to do them on YouTube. So let's see here. Yeah, that's exactly right. Clickety click. Yeah. Now your real estate person is neutral instead of bearish. Correct. And so that these are real easy concepts, folks. I've been around. This is hard to believe. We're about to come into 2024. So it makes 45 years I've been in these markets, since 1979. I started in, I think it was September of 79 when I walked on the trading floor the first time. Sorry about that. I got family members that are texting me. Anyway, it's been a long time, and I've been telling this, and it's been really easy to figure out what's not going to happen. And it's not just from listening to Kramer. You can get a really broad sense. Sometimes the consensus trade is there and everything goes that way, but for the most part, it doesn't. So anyway, I guess that's going to do it. I'm getting people texting me. They knew I was live. I said, don't text me, but they do it anyway. That's okay. I love them. So it's all good. So anyway, folks, thanks again for showing up. Yeah, so here's the thing, Daniel. Just go back and watch the replay. I went through the S&P and I covered all that pretty good. Yeah, Twitter handle. Yeah, I told you. I need to tell you that. It's Portfolio Expert. So it's Twitter/X/Portfolio Expert, and there's no E in expert. So it's Portfolio, just the X, and then PERT. And you will get there. But follow me. I'm trying to get a little more active there after the first of the year, trying to get a lot of these things out that I want to do more. Like I said, I'm pivoting here on the channel to more educational, more macro than the micro. The day-to-day stuff, just it's a lot of work. I miss doing it. It's very restrictive on my work habits and everything. So I've got to exit out, and it's okay. But I'm going to have a fair amount of content. We are working on a number of scripts. Like I said, I have a script on productivity impact on the GDP coming up that I think is going to be very interesting. And that should have, and some of you will shake and say you've heard this, but once you see it, the projections and what are possible really is really what I'm focusing in on. And you folks have known me, most of you know me since the pandemic. Other folks have known me for decades that have been our customers that watch. And I can tell you that I have had, for whatever reason, a knack of looking forward and seeing things a little bit differently than everyone else. And this is really the crux of this upcoming video is, for the most part, is how everybody's looking at the wrong metric. Everybody's got it wrong. I know that's kind of cocky, but I think this is how it plays out in the end. And some folks, and I don't like the global label, so I'm going to say some folks definitely will get it, okay? It won't be everyone. All right, folks, this is going to do it. I appreciate everybody watching, as always. We managed to hang out with a couple hundred. I'll play our typical ending we do on our live streams. Everybody likes that music, usually hangs out and listens to the song. So thanks again. Hit the like button, hit that bell. Make sure you do that. Subscribe, because these videos aren't going to be, you can't expect me to be here every day at 6 p.m. like I used to. So make sure you hit that. Maybe that'll help the algos too. And ultimately, I think we're going to grow the channel pretty substantially. Thanks again for watching. I just feel like I've been hanging around with a bunch of friends, and I know, don't see too many trolls. We do have a couple Smurfs around, so everything's good. So everybody have a great weekend. I plan on doing something on Sunday. I will put something on Twitter, so make sure you go to X. Hard to switch over. Go to X, Portfolio Expert, no E in expert, and that will get you there. Have a great weekend, everyone.